with Karen Fawcett, who is Group Head of Transaction Banking at Standard Chartered, a bank that has operated for over 150 years in some of the world's most dynamic markets. The bank earns around 90% of its income and profits from the Asian, African and Middle East region. Karen, recovery is a key theme for Sibos this year. How well do you think this resonates in Asia? What's the current state of health in the region?
Well, we believe that Asia is driving the global recovery. Relative to many other markets, Asia had a relatively good crisis. We now see that Asia has bounced back, and IMF reports are expecting Asian growth to be 3 times that of OECD markets this year. I think there are a few reasons why Asia bounced back so quickly. The first thing is Asia has had many crises over the last 10 years, and as a result of that, the banks consolidated, got much stronger, and were working in a quite strict regulatory requirement. The second thing is that the governments stimulated the economies very quickly. India and China in particular put a lot of money in as OECD demand fell. They stimulated the economies, and that kept things going. And thirdly, we're seeing just Asian demand amongst the countries growing tremendously. So we have a situation now where I believe Capgemini and Merrill Lynch came up with there will be more wealth from Asian millionaires this year than from European millionaires. China bought more cars last year than the US, and we're just seeing investment flows coming from OECD markets rising tremendously going into Asia. So Asia is in good shape, and I think leading the global recovery.
Asia as a region is known to be extremely diverse and fragmented, culturally, politically, and also from a business and regulatory perspective. Regulation is also a key theme for Sibos this year, and while Asian banks survived the financial crisis in better shape than those in the US and Europe, as you've pointed out, is there a danger that the push for global regulatory reform may have a negative impact on banks in the region? And also, what are some of the other factors that come into play when trying to break into such a market?
There's no doubt that global regulatory reform will have a big impact on the region. I think we're expecting globally, for example, if Basel III is implemented, the extra capital requirements, for example, on trade finance are going to put up costs in the system almost 20%. When we look at the different countries in Asia, though, it will vary by market. There are some countries, for example, Hong Kong, Singapore, Malaysia, Korea, that already have very high capital requirements and liquidity ratios in place. So that may not affect the amount of capital too much. In other countries, or with some of the weaker institutions, we expect the impact to be quite a lot. But one of the main things, moving from, most of these markets are still using Basel I. So which means that they don't have the sophisticated models in place on a general basis that are required for Basel III. So they've got to go through that infrastructural model building phase before they can move on to Basel III, which will have a huge impact on the banks. But that assumes, of course, that the local regulatory authorities adopt Basel III, because, as we say, many markets did not require the adoption of Basel II. In terms of the second part of your question on other things to think about, I mean, Asia is very fragmented. Many small economies with very different regulatory language, cultural requirements. Licenses are extremely hard to obtain, and there have been some recent acquisitions where even the transferal of licenses posed a lot of challenges with the regulatory authorities. I think we're also seeing that regulations change very frequently. I mean, our team in China could be facing several regulatory changes a week, which could impact the way you do your process flows or the products that you offer. And I think one of the big ones sweeping through the market at the moment is the impact on RMB. I mean, China wants its 2.7 trillion of trade flow to be denominated in RMB in the future, and that is spreading very rapidly.
Besides regulation, what else do you think banks need to be aware of?
Well, we're seeing a lot of OECD banks trying to come into Asia at the moment, and I think the first one is to really understand how the local economies work. And this is an environment where credit rating agencies and credit bureaus are much less developed than in many other parts of the world. So real knowledge on the ground is essential to avoid making mistakes. I think the other thing is we're seeing the growth of activity in specific trade corridors, and those are often driven by demand for commodities, so whether that's from the Middle East to Asia or Africa to Asia. So having linkages or capabilities on both ends of those corridors is becoming increasingly important. So finding a way to have an efficient model where you can cover all the nodes that are required without adding enormous cost is the main challenge. I mean, for many of the smaller banks, they are beginning to talk more seriously about working with banks like ourselves. Obviously, one of the things that banks can do is work with a bank who is on the ground already. And one of our themes for Sibos will be how we can partner with other banks, offering our network and our on-the-ground capabilities. We've been there for 150 years to see how we can work together to help them tap into the growth in Asia.
Karen Fawcett, Standard Chartered, thank you very much.